Warren Buffett, one of the most successful investors of all time, has developed a set of principles over the years that have guided his investment decisions. While his approach is nuanced and multifaceted, here are 7 key rules that encapsulate the essence of his investing philosophy. 1. Invest in what you understand. Buffett emphasizes the importance of staying within your circle of competence. This means investing in businesses or industries that you understand well. By focusing on areas where you have expertise, you're more likely to make informed decisions and avoid costly mistakes. Buffett famously avoids investing in technology companies because he believes he doesn't fully understand their business models. 2. Look for businesses with a durable competitive advantage. Buffett seeks out companies with a strong moat, a sustainable competitive advantage that protects the business from competitors. This could be in the form of a strong brand, high barriers to entry, superior technology, or economies of scale. Businesses with a durable competitive advantage are more likely to maintain their profitability over the long term, providing steady returns to investors. 3. Buy quality businesses at reasonable prices. Buffett is known for his focus on value investing, which involves buying high-quality businesses when they are trading at a discount to their intrinsic value. He looks for companies with strong fundamentals, such as consistent earnings growth, solid management, and a history of generating high returns on capital. By purchasing these businesses at a reasonable price, Buffett aims to achieve above-average returns over time. 4. Think long-term. Buffett is a staunch advocate of long-term investing. He believes in holding on to quality investments for extended periods, allowing the power of compounding to work its magic. Buffett famously said, "Our favorite holding period is forever." By maintaining a long-term perspective, investors can ride out short-term market fluctuations and benefit from the growth of their investments over time. 5. Focus on intrinsic value, not market fluctuations. Buffett pays little attention to short-term market movements and instead focuses on the intrinsic value of the businesses he invests in. He views the stock market as a tool for buying ownership stakes in businesses, rather than a platform for trading stocks. By estimating the intrinsic value of a business based on its future cash flows, Buffett can assess whether a stock is undervalued or overvalued, regardless of its current market price. 6. Be fearful when others are greedy, and greedy when others are fearful. Buffett is known for his contrarian approach to investing. He believes that market sentiment often swings between extremes of greed and fear, creating opportunities for astute investors to buy low and sell high. When the market is in a frenzy and stock prices are soaring, Buffett becomes cautious and looks for bargains. Conversely, when fear grips the market and stock prices plummet, Buffett sees it as an opportunity to buy quality businesses at discounted prices. 7. Stay disciplined and patient. Finally, Buffett emphasizes the importance of discipline and patience in investing. Successful investing requires sticking to your strategy, even when faced with uncertainty or volatility in the market. Buffett advises investors to avoid impulsive decisions driven by emotions and instead focus on the long-term fundamentals of the businesses they own. By staying disciplined and patient, investors can navigate market cycles and achieve their financial goals over time. These 7 rules encapsulate Warren Buffett's timeless wisdom and provide a framework for successful long-term investing. While investing requires diligence, research, and a willingness to learn, following Buffett's principles can help investors build wealth steadily over time.